Hey everybody, welcome to this free edition of our Trader User Group's weekly roundup. This is for the trading week ending November 1st, 2019. Everybody, I'm Preston Brent. Thanks for tuning in. This past week, I kind of call it the attack of the killer bees, in an ode to Barron's in an article this weekend. What we've seen here, all of the markets across the U.S. finished in the green, both the Dow and the S&P up over 1.4%. Russell is up a big 1.7% in actually the Russell led the way at 1.9%. NASDAQ was up 1.7. And we saw a volatility index finish off the week fairly low, around 12.30. It's the lowest it's been almost 52 weeks. And then looking at the global markets, really the only market that kind of suffered a little bit of a sideways to slightly finish in the red week was the FTSE over in London. And then, of course, the CAC 40, the DAX, the Nikkei were all up, anywhere from 20 to 50 basis points. So they kind of finished a little bit into the green. China was just above flat line at 11 basis points to the upside. Hang Seng over in Hong Kong, even given all of those protests over there, it still managed to finish 1.63%. And, this week in the U.S., we saw the best sector performer being healthcare, finishing the week at a whopping 3.05%. The worst was energy, bringing up the rear. Underwater 0.27% or 27 basis points. Also, looking at the PE ratios in the markets, the trailing 12-month PE is 21.96. The forward PE guidance, based on the number of analyst estimates, is around 18.5. So the forward 12 is still about 15.5% less than where we've seen in the past, which makes sense. The annual S&P dividend yield has come in just a little bit because we're moving higher. So the annual dividend yield is still better than the 10-year interest rate. So 1.89% is the annual dividend yield. The 10-year interest rate closed out the week around 1.73. So as long as the dividend yield in the S&P is still outperforming the 10-year, it's still going to funnel money into the U.S. equity markets. Okay, so just understand that. This is a weekend where most of us over here in the U.S. are going to be setting our clocks back 1 hour, which, is kind of traditionally introduced the beginning of much colder months ahead, kind of bringing on winter. But looking at the prices, really across all the indexes, are hot and only getting hotter. I mean, as I said earlier, we saw record all-time highs this past week in the S&P and NASDAQ. The Dow is only about 4 basis points away from hitting all-time highs. The Russell is much further behind. And if we do get a mad dash up higher, then you're going to see the Russell start to play catch up. So there's a couple of good plays in that I had mentioned to our members that some of them took advantage of this past week. I've also told all our user group members that right now price action in the markets is kind of like sitting on a bar stool, a three-legged bar stool. And those three legs really are Q3 earnings, which even though the expectations were very low, they're still beating at a record rate, better than the 5-year average. So earnings are coming in better than expectation. The other leg in the bar stool is the Fed interest rate policies going forward. So it seems to be they're going to be accommodative because we had another 25 basis point rate cut this past week. And the third leg of this three-legged bar stool is China trade. And we got good news this past week that they're making progress, and they've agreed in principle, the head negotiators from both China and the U.S. have agreed in principle that they've got, this thing ready to go. So I'm looking for a trade deal signed in the next 2 or 3 weeks before we get into the holiday season here in the U.S. markets, which would be the last towards the end of the month of November. So getting cooperation across all these three legs in the bar stool, right? The Q3 earnings, Fed interest rate policies, China trade, getting cooperation across those will not only propel us to new all-time highs, which it's doing, but I think it's going to allow the S&P to breach 3,100 and move much higher. As you guys know, if you've been following me here, we're pretty good at where we're picking out and charting the markets, and I can see the markets moving up 3,150, even 3,200 over the next 90 days if we get this cooperation. Okay, of course, the march higher is going to be a little bit tenuous with fluctuations that we get in news reports, headline news, coming China trade progress, because we still haven't completed that leg of the stool yet. but price action just appears to want to move higher, right? And to top all of this off, we're heading into historically what's been a very bullish time for the U.S. markets as we round out 2019. November and December tend to finish up 70% of the time from where we go into the month to where we end the month. So, we're on track here, and of course, when we're hitting all-time highs, it's kind of there's always folks out there that are going to find a fly in the ointment, right? Or a fly in the soup, which in turn, there's still a lot of cash on the sidelines as we move higher. This cash is held by pension funds, mutual funds, insurance companies, and so forth. And that cash is going to be forced back into action should prices continue higher. And typically when prices are hitting all-time highs, we see the pundits rush out to judgment, condemning higher prices and pointing out all the potential landmines, which there are many, I will admit that can blow up any kind of bullish run. But this, again, is normal as we move higher. But that's going to amplify more cash that's going to be forced to come back into action, giving us kind of a FOMO, which is many of you probably already know, is a fear of missing out type of mad dash from cash back into equities. So there will be a time to be fearful, but we're not there yet, okay? Now, I mentioned earlier the attack of the killer bees. Well, last year it was all about the killer bees. That would be the triple B rated corporate debt bonds. And if we look at it, it was very mainstream last year. Everybody's fearful. And why is that the case? Well, triple B is the lowest credit rating level that a bond can hold from a corporation and yet still maintain investment grade status. And the reason why that's so important is a lot of big money by charter and investment guidelines cannot invest in corporate bonds that are not investment grade status. So a lot of these big firms move down the credit profile to the triple Bs to get more yield, right, in search of yield, which is what they're trying to do. But should a company lose its triple B rating, then they go into the higher end of junk status. And then those big moneyed firms are going to be forced to sell those bonds, which continues to exacerbate and drive the interest rates higher of those bonds. So that was a big worry last year. But looking at it this year, which is really another reason why I don't see a recession anytime soon, is that we're seeing the yield spread between the triple Bs and treasuries actually falling a little bit. And just remember the term thin is in. So when the yield is thin or tighter, that tends to bode well for equity markets, right? So it's one of those things that doesn't indicate any credit risk yet, has moved higher at this time. It always tends to be favorable for current equity markets. So that's, generally what we like to do when the markets are reaching topping actions. We look for breaks in the ointment or cracks in the armor, if you will, and looking at the credits and the yield spreads don't indicate that at this time. Now, should the 10-year start to fall and come back down towards the levels that we saw about 90 days ago, maybe 4 months ago when it was down around 145, now we can start to get a little bit more worried about it. But I don't see that at this time. Also, on Friday, to round out this past week, we had job numbers come in, and we saw numbers coming in at 128,000, which was a lot better than expected. I think they were only expecting 70 or 80 grand in jobs. So it came in at 128. And not only that, but the revisions in prior months were also revised higher as well. And that's on back of the General Motors strike, about 40,000 people out, 20, 30, 40,000 out of work on the strike for over a month. Census Bureau folks not working. So, that just really is strong numbers, guys. And the other thing is it shows you consumer is still strong with the jobs and the job market. And keep in mind, consumer spending is about 70% of the U.S. GDP. So we're getting ready to go into the tail end of the year, which tends to be strong for retail sales. And the National Retail Association is saying that, retail sales should come in at 3.5% to 4% growth year over year. And coupled with the VIX volatility, which is a measure of volatility coming in near a 52-week low, it's setting us up for a strong run. Now, I will admit any Trump tweet or any offhanded remarks can give us some downtime. But as you saw on Friday, even a lower move in the PMI data, manufacturing data below 50, which shows an official contraction, was not enough to offset these strong jobs numbers, because manufacturing now is about 10 to 12% of the U.S. GDP, while consumer spending is 70%. So that's kind of what we're paying attention to as we move through the end of this year. Now, if you look at the chart I have on the screen here, this is the E-mini S&P 500 futures, and it is on a weekly basis. And you can see this area right here and this area right here, which we use in our group for picking up more hedging or just giving us an idea of a target range. So you can see that target range right there was set earlier in the summer. We came up and hit it. We started hedging in the month of May for this move right here, and we hedged in the month of August for this move here. So I would not be surprised to get caught up here a little bit, have a little bit of a pullback, but again, we're in a buy the dip kind of moment. And then blast up higher like that. I think the momentum is still very strong. And if we get the signing of this phase one deal in the China trade deal, no matter even how minuscule it is, if the markets see we're making progress, then that's all the markets really want to see. So the risk of a move right now is more upside risk than downside risk, depending on your directional bias in your trades. And again, looking at the chart here, you can see this upside area here around 3081 all the way up. It'll take us up to about 3100, which would be a natural area. Now, we've come a long way fast. I mean, in October 3rd, we kind of started off the month. We were down as low as 2853 on October 3rd. And we made all-time highs this past week at 3063. So, folks, that's a big run in the month of October. A strong finish to the month, okay? So I can see a little bit of a give back here, but again, I just don't see too much of that. You can see this yellow line here is a value area where bulls and bears volume-wise was the most extreme, which puts us at about 2985, around the 3000 area. And as I was telling our members, we got a wider support range here, sitting around 3010, 3025. As long as that holds, even on a dip, and that's where I'll be looking for the markets to hold if we do dip, then you'll see more cash coming in and playing in this arena here. Okay, so, and you can also see this red line, which is the 50 EMA, and the yellow line, which is the 200 EMA. You've got upward vectors, very strong. So these are all good signs for this chart. Okay. Now, if I were to show the SPX, and let's keep it on, let's put it back on a weekly chart here, right? And you can see this kind of a rising wedge that we have here, and we're just now starting to break out. Now, typically in this kind of wedge, the break to the downside is a higher probability move on this kind of movement here. And this goes all the way back to January of 2018. But we're just now breaking out of that. If we can break and hold, then that will give us the move higher. And what is the impetus to get us up there? That would be signing phase one, and then coming out of that signing, having good news on progress being made on the rest of the deal. All right, that'll get us up there through that 3100 level into 3150, possibly even 3200. We could have a nice little run here. Okay, so just understand that. And all of these bearish forecasts, because you see them come across, you probably get them in your subject line in your email that the markets are crashing. There have been people that have talked about the markets crashing for 8 years. So what are they doing? Sitting on the sidelines and missing out on this run? I think what a lot of these folks do is like to call the most extreme bear move. So eventually, at some point in time, they will be right, and then they'll get kudos for being right. Even if they may be off 3, 4, or 5 years or 6 or 7 years, then they get to go on TV on prime time and talk about how they were right. Meanwhile, they just missed the timing by a half a dozen years or so. All right. So a lot of them do it for just TV and speculation and to get more bragging rights. For us here in our user group, we're really all about making the money. So we got to let price action tell us what the markets want to do. Near term, the markets want to go up. If that changes for our users in our user group, then I'll let you guys know. If you're not a member of our group, I highly encourage you to come in because we're doing really well, especially from an international perspective too, because it's a macro market and you got to have macro plays that you're moving as money rotates from one sector to the next and from one country area to another country area. So this is what we're looking at on the SPX. Now, if we come over and look at NASDAQ, which was the other one that hit all-time highs. You can see here with NASDAQ, we came up, hit all-time highs here. And in fact, let me just set it because we had a new all-time high here at 81.68. Okay, so you can see on this weekly chart how we're getting kind of a divergence here, which would suggest we could have a little bit of a pullback. Okay, and I don't see the pullback going too far, but it can, give us a 100, 200 point pullback, and then that would actually be, I think, more bullish for the markets, propelling us higher into the month of December. Okay, so that's a little bit about NASDAQ. Now, if we look at the Dow, you'll see that we came really close to all-time highs. I mean, just really close. If we look at this, and let me just put it back on a daily chart here. You can see here that we're still struggling because we came up this close again back in September before we gave it all up here back this September time frame. So you can see we're right back up where we are again here. So I think assuming everything rocks and rolls, then we're going to see the Dow make new all-time highs as well. The only one that's concerning me a little bit, but it's playing catch up, is the Russell, and this had the best day on Friday as well, which is a good thing. Okay. So if you look at it, we've had a cross in the 50 and the 200 back at the beginning of October, but then we've started this massive rally back up. I mean, just huge rally. Like the S&P, the Russell was down around 1453, right? 1455, and we finished at 1589. So it's a 130 point move in the Russell in the month of October. Just a really strong move. You can see the bull and bear value area here sitting right around 1564, but we still got to clear this area. All right, if I were, as I showed our members here, I can blow this up a little bit, but I don't want to. You can see here, if I just kind of highlight that area just like that, and my lines aren't that straight, but you can see, and if I were to carry it over like that, you can see over here where it was support, strong support in this area. So our line in the sand is this area, right in this area here, price wise, from 1475 to 1450. Should that break, things are going to get ugly. I don't think it will. I think the break is probably going to be on the upside, and we're going to make new 2019 highs. Okay. And if you really think about it, if I step out even more, if I put it on a weekly chart, you can see just how much of a sideways pattern we've been since our all-time highs of 2018 in the Russell, right? Here is the all-time highs in the Russell right here that was actually made in September. It was about 3 or 4 weeks earlier than when we made the all-time highs in the Dow and the S&P. And you can see we made these here, and now we've just, to some extent or another, been in this really tight, and I can extend it all the way back here. This is where all this movement is coming from, right, like that, right, on this weekly chart. So we've been kind of stuck here. I do not count that, as most of you guys probably already know, that was a Boom Boom Powell, our illustrious Fed chairman, Power Ranger Boom Boom Powell. He increased the interest rates by 25 basis points around December 3rd, and then he made a mistake, and then early January he said, my bad, and then the markets took off again. But the Russell has never been able to get a lift, and it needs a lift to be able to carry the rest of the market. Should we break out and we start a run, then you're going to see the Russell really run, okay? And there are some really great plays that I've reviewed with our members that are already in some of these trades right now. So that's a little bit about what I'm seeing across these major indexes. If we look at emerging markets, you can see here the emerging markets look sort of like the Russell. It's still a lot of weakness in emerging markets. Okay, you can see the 2018 close. That's where we opened. So a little bit of a respect. We had an advantage because we closed so low in 2018. It gave us a little bit of an upside momentum here going into the new year. But you can see the 2018 low, 2018 close, 2019 low. So there's a lot of support down in this area here. So I'd like to see emerging markets continue higher. They're going to go where China goes, right? So we're going to kind of see how that plays itself out. Transports, you can see transports, which also looks like the Russell, all right? You can see right here, I mean, these things keep bouncing around on me, which is really it's a little bit annoying, but it does bounce. Right here, this was the all-time highs, 2018 highs. You can see the 2018 open, or I'm sorry, that's 2018 high, 2018 open right here. But you can see here where it looks just like the Russell. We're kind of just flatlining between these two areas, chopping from high to low. We need to see a breakout in transports as well. Okay, And then across transports, there are a couple of key areas that we can play that I'm going to review with our members here. And of course, if we look at Asher, which is a tracking stock for China, you can see here, like the Russell, we're below the 2019 high. We've got a little bit of a, if I were to guess, I don't like to guess, but I can just kind of draw it in like this. A little bit of a symmetrical triangle. Generally, it breaks to the side that you enter it from, so we kind of coming up like that. So the odds favor a break here and a takeout here. So if we get that phase one deal done, this is where Asher is going to go. All right, not its highs from 2018, but this is gonna take out, it's gonna make new 2019 highs for sure. Okay. So these are just some of the things that are on our mind at this point in time. And of course, if we come down and look at volatility in the VIX, it's in the green zone. You can see here I've got every zone colored based on, and it kind of helps us with, it helps a lot of folks with option strategies and things like that, depending on what zone you're in. So we're in the green zone right now. We haven't been this low for quite some time. You can see we kind of tested it in the summer months of this year. But it's coming down pretty low, which means you got to be careful because the risk of a bigger move now is more upside than downside. But having a low vol coming in November and December is a good thing because this is when we traditionally tend to be bullish anyway. So let's see how this thing really plays itself out, folks. But that just shows you that hedging right now, hedge premium is very inexpensive. So, just hedging to the downside can make sense. In our user group, we just closed a couple of trades this past Friday for profits, and we had one that we call the Gator that we closed on Friday, which is really good. It works really well in low vol environments, especially low vol moving to high vol environment. Our Gator trade is really a cool one to play. So this is kind of where we're sitting right now in the volatility market. And if we look at the front month vol skew, you can see we're definitely in the green here. This is on a weekly chart. All right, I have to change it every time we change over in the volatility futures contracts, but we're in the green, so we're in a contango environment that's normal for the volatility markets. And if we look at the back month skew, still deeper in the green. So that just means there is absolutely no fear out there going out through the end of this year right now. So that goes in jives with everything else that I've been talking about the markets, right? If we look at the bond market, again, you can see here, it's a little bit of a chop. We're making a series of lower highs, but we did make a lower low there. So it just indicates that the bond market is working off this big move that we made back in August when the markets really kind of came teetering off the table here, okay? And right now there's no trade in the bond market. All right, if I had to suggest from this stock, it would indicate that, or this bond futures, that it's going to go lower. It's going to run up here, run out of energy, and roll back down again, which means interest rates are going to go higher. And that's kind of the bet that we've made with using an ETF that's common to play interest rates going higher. There are a couple of different ways to play it, but with our users in our user group, I've got a way out there. We've already made some profits on it now, and I think at longer term, it's going to continue to be a winner for us. Currency-wise, if we look at the euro, you can see here it's backing up off the lows down here. I'd said down in this area here that it's probably going to move to the center line of the regression channel, which is what it's done. And remember, when the euro moves up, more than likely the dollar index is going to move down, which we're seeing. So we're right on the center line right here. I'm not ready to call a bullish trade in the euro yet, right? But you can see a series of lower highs, lower lows on this regression channel as we move down. And of course, the dollar is going to be just the opposite. It's off of the highs here, and we're back down in this area here. The only time I'm going to call a change in trend here is if we come down outside this regression channel. We'll probably have a retest and then a rollback over again. So this would suggest that we're going to start to see some relative strength currency-wise across Europe, which should be a really interesting sector rotation play here in the currency market. And then finally, the one that's going to have a lot of juice for us over the next 30 to 60 days, you can see the pound was just really following this really tight regression channel down to the downside. Once it broke to the upside, we had a little bit of an attempted retest, a failure, and then boof, off to the races we go, right? This was a little bit of a bull flag right here, and it broke to the upside, so the pound wants to go higher. I mean, it's just a natural proclivity to want to go higher. Looking at the MACD, there are no divergences, so that suggests any sell-off is going to be picked up, right? Keep in mind the pound is about 12% of the value of the dollar index. The euro is about 58% of the value. So when you add those two together, you're at about 70% of the value of the index of the US dollar. So this is just going to push the dollar lower, which is what would be good for US manufacturers as well. Okay. And then looking at precious metals, um, with all the machinations last week, we're in this profit-taking mode. Now, we got long gold right over in this area here around 20 June. I have this breakout of this ascending triangle here. We went long, and now this is profit-taking right here. You can see a little bit of a pullback. If we break the upper boundary here, then I think it's going to get long and go even higher. Same thing with silver, right? Silver is in this profit-taking mode too. One of our precious metal trades of choice was silver, only because the ratio of gold to silver got too extreme, way higher than its 15-year average. So I had recommended to our group that we go long silver, and the timing was really good because we were getting long down in this area down here. Away it went. So now this is some profit taken in this area here. We have broke to the upside in silver. So we've gotten a break, which suggests it can get stronger as we move forward over the next 60 to 90 days. Okay, so that's a little bit about where we are here. And then, of course, in the oil markets, you can see we're right around the area that I said we would be around, which is around $55 a barrel. The value area is sitting right at 55.70. All right. And we finished the week at 56.23. I think the upside is limited, but I think the downside is limited. So there's going to be a wide range chop here near term that you guys can take advantage of. Keep in mind, OPEC is meeting in Vienna. I think it's on December 5th through the 7th. It's typically a weekend, but OPEC will come out and put their prognostication out on oil demand, as well as are they going to extend their production cuts to keep oil artificially high. Okay. And they're going to have to with the fracking that the U.S. is doing. So this is a little bit of a kind of a wider range sideways move in the oil market. I don't see anything that's going to get us over 60 near term, short of any kind of conflagration over in the Middle East. And I don't see anything that's going to get us below the 50 area as well. So call it the mid 50s is kind of where we're going to park ourselves for a while. Nat gas is all about the weather. You can see here we're coming back up. We're testing this area. It looks like if it stays up in this area, moves even higher with all the cold moving across the USA, then this can move up, which gives us zero divergences, which means any pullback is going to be bought. Remember, over in this area here, I was suggesting bull put spreads. Once we hit this level here, I suggested bear call spreads. At this area here, I would not suggest that at all. I'm going to wait and see if it can give us a better entry setup. Okay, so that's nat gas. And then, of course, if we come over and we look at the ag market, corn was one that was really good for us. We came in corn down in this area here, and I said you got to do bull put spreads or bull call spreads, or just pick up some options or some futures, right? Because oil or corn is going to go up. It was near a 2016 low, and really a low price for corn. So generally, I love commodity markets when you get a displacement like this, lows that hadn't been seen in a while, or highs, same way. And this one was low, so I think the odds favored it moving higher. And then if a China deal gets done and they come out and they start buying more ag stuff, it's only going to boost it higher. Okay, so that's a little bit about where we're sitting right now in these markets. For you members out there, I will see you this Sunday evening for our weekly market watch. If you are not a member, we got a Halloween special going in. I'd encourage you to take advantage of it. Generally, the trades that we're running, it'll pay for itself very quickly, especially in the commodity market. I mean, there's some great ones out there, and I think there's going to be some curveballs thrown out in Q4 going into Q1 of next year into January. So there's going to be some opportunities here for our members. Otherwise, have a great weekend, everybody, and folks. I will see you later. Ciao, folks.